Hi everybody, David here from Mortgage Choice. Great news from the RBA. The interest rates have dropped by 0.25%, bringing the cash rate officially down to 3.60. Now, we're expecting all lenders to pass on this same cut over the next few days, and you should see that hit your existing repayments for those mortgage holders in the next 1 to 2 months. For some lenders, they've actually already passed it on, and that's going to be reflected on clients' accounts overnight, which is pretty exciting. So, as always, I'm going to run through a little bit about what the RBA has said, what I'm seeing in the market, and what this rate cut means for existing home owners and people looking to get into the market. So, let's get stuck into it. Now, the official statement was that they're happy to see that inflation has reduced. It's within their guidelines. They wanted to see inflation sit between 2 and 3%, and both headline and trimmed mean inflation are exactly where they want that to be. So, provided that stays in the range, we should see some more cuts. If it doesn't, then they'll make adjustments, but we should see some more cuts over the following months. What this cut means for you. Now, this is just an example of a $100,000 loan. But you can see here that for an existing home that might have a rate of 5.65%, that's going to drop you down to 5.4 and drop your minimum repayment down by about $16 per month. So for a $500,000 loan, that's $80 a month back in your pocket, which is fantastic. Now, on the flip side, if you want to continue that higher repayment, you'll be paying down your loan by an additional $16 for every $100,000 that you owe. So it could be a great way if cash flow isn't a problem to just reduce the debt that you've got and not make too much of an impact on your living costs. Now, this is what I mentioned before about where interest rates are heading and should we see another cut. The ASX are still predicting more cuts. You can see this is just from yesterday, and they were expecting us to have the cut down to about 3.60, which is where we are now. And they're expecting another cut, later on this year, and continuing cuts until we get about 0.5% lower. So would love to see that continue. We'll have to see what happens with inflation. The RBA, as we know, are very conservative. We were expecting a cut last month and it didn't come through. So we'll have to see what happens month by month, decision by decision. But this is still a good outcome. This is where we want to see things headed. For first-home buyers, I'm seeing a lot of first-home buyers with large deposits, which is fantastic. It means that they've got lower repayments. They're not going to be as impacted by the higher cost of living when you own your own property, moving out of mum and dad's. They're comfortable, so that's fantastic to see. It also opens up more lender options and lower interest rates for them. So really, really happy with that. Interestingly, I've been seeing that they've been offering longer settlement periods. Rather than a 30-day settlement, they're typically seeing 60 to 90. And I'm not too sure if that's from the buyer's point of view or if it's the vendor that wanted that longer term. And the first-home buyers are happy to oblige. Then they're not going anywhere. They're staying with mum and dad until they move out. But a little bit different to what I've been seeing in the past 6 months. The first home guarantee scheme for financial year 26. It's all up and running. There's places are available. So what we need to make sure if we're applying for this as a first home buyer is that you've completed your tax return for the tax year just gone by, for the end of June 2025. As soon as that notice of assessment comes back from the tax office, we are ready to go ahead, apply for pre-approval and secure our spot under that scheme. And just as a reminder, that scheme means that you avoid mortgage insurance when you're looking to buy a house. Excuse me. For upgraders, I'm seeing a lot of inquiries around building. Some people looking to knock down, rebuild. Some people looking to simply buy a block of land and build a bigger house for themselves and for their family. So that's nice to see that that there are more properties being built. That market is coming back, but it's much more expensive than it was 5, 6, 10 years ago, as you'd expect. But definitely since COVID, the cost of materials has increased the cost to build drastically. So you're not quite getting as much as you would have for your money a few years ago, but people are still looking at building a new house. Accessing the deposit is always a big question. How do you get the deposit ready for your next home? How do you get the deposit ready for the builder? There's a couple of ways to do this, but typically once we know what your affordability is, we'll do a separate little loan to access some equity from the property if you don't have cash. And that's ready to then give to the builder so they can apply for their permits and get the build underway. Investors, I'm seeing a lot of inquiries around units rather than investors building or buying established properties, standalone properties. They're definitely looking to units. So that's been interesting. I'm not too sure if that's, again, just the price point, or if they're seeing really good yields from units. So why spend more if you can get the same yield from a cheaper property? But units are definitely high on investors' lists from what I'm seeing at least. And principal repayments, which is also interesting. Typically, when you buy an investment property, you want to reduce the holding cost of that property, and so you turn your repayments to interest only. Lower cost, you can hold the property for longer. You're not paying down the debt, but every single dollar of your repayment is tax deductible, provided you meet those requirements when it's interest only. Principal and interest, however, you're paying down the debt. Less debt means less interest, which means less tax deduction, but it also means a higher repayment, and so your cash flow is hit harder. But investors are happy to go ahead with that these days. They're happy to see the debt reduce rather than maintain a higher level of debt. So that's been interesting too. Fantastic that clients are happy to pay down debt. At the end of the day, we want to retire debt free, but it's been interesting to see that investors are still okay with that, regardless of if they've still got a home loan to pay down first or not. So yeah. But that's it for this month. So again, great news from the RBA, down by 0.25%, and we should see that cut come in the next month or two from a repayment point of view. But from a rate point of view, you should see that in the next few weeks. And yeah, as always, if you've got any questions, be sure to reach out. Would be more than happy to have a chat. Thank you.